excited today to welcome Blake Smith, who no doubt you've read about because you're here. But Blake has been a successful founder who has some real expertise in the topic of raising money when you don't live in Silicon Valley, which, having talked to lots of startups, is what I do in my day job. I know early stage capital is one of our challenges or opportunities, depending on how you want to look at it, here in Cincinnati. So great topic, certainly very relevant. Excited to have him here. We do have a check-in sheet in the back. If on your way out you can check off your name, that'd be awesome. And also, we'll have feedback forms. Not that you need to critique Blake, but more importantly, we just want to know how we're doing, other opportunities to add value, topics you'd like to hear about. You ask and we'll work on it. So thank you very much, and I'll give it to Blake.
All right. Cool. I'm going to set a timer, so hopefully we can get through this and do, I think we have an hour and a half for this, is that correct?
Yes.
Hopefully we'll take maybe 45 minutes or so, and then I just want to jam on any questions that people have. And then do people also they can book time afterwards to talk? Is that true? Is that a thing?
It is a thing.
Okay.
It is largely open at the moment. I'd say we perhaps didn't give the right mechanism to do that. So
okay.
If you're willing to do office hours,
yeah.
hang out.
I'm planning on doing office hours for this afternoon, so if anybody needs help, I'm happy to look at decks or work on it, whatever. So should be good. Cool. All right. So like I said, my name is Blake, and today we're going to talk about the fundraising process. And specifically, that is kind of the big focus for me, is running a process as opposed to maybe just trying to fundraise. So a little bit about who I am. I think most of you, is everybody here a founder of a startup or working at a startup? Yes. Who here has raised ventures already, or raised investment so far? Okay. Who here is planning on raising investment? So, okay, great. This is a great room. Cool. Yeah. So, can we? Yeah. Let's see. Turn off the light. Is it hard to see? Yeah, it's a little hard to see. So I'm a founder of a startup called Cladwell. We started Cladwell 7 years ago and just sold Cladwell, I guess it was in August of last year. We were venture backed, raised several rounds of funding, and I'd say we did kind of the Midwest style, which was friends and family, including like grandma, kind of hit the edge of that, went to angel groups and maybe regional groups, ended up raising money out in Silicon Valley, and then later raised, I'd say our most highest tier was raised some money from Science Incorporated in Santa Monica. They backed like Dollar Shave Club and Bird and a couple other folks. So I feel like we kind of did a full progression, and I'd say my progression was one of going from maybe unconscious incompetence to maybe some competence to actually finally learning an actual process for this. So I showed a couple pictures. This is when we moved out to Silicon Valley. At the time we had 3 kids, now we have 5 kids. This is my son Everett. My associate Everett is here with us today as well. We went out for 500 startups, which kind of kicked off our fundraising process. And so in about a 6-week process, we pitched 150 VCs in 6 weeks to raise our kind of larger round of funding. And so that's a picture my wife took of me on my patio. This was a lot of my life, was either going to meetings in Silicon Valley or sitting on our porch with headphones on, just pitching constantly, 30 minutes at a time. And that's us having wine at the end of the night. And that was my entire life, was these 2 pictures. Was I'd pitch all day and then hang out at night and then go back and do it again. And it can be an exhausting process for sure. So what I want to talk about today, is, why am I here? That's the other thing. So that's who I am. Why I'm here, it felt to me, or feels to me, like it felt like there's a small group of people out there who knew how to raise venture capital, and typically they were like founders who are at further stage companies. For me, some of those people are like Austin Allison over at Dotloop. I had his phone number because I took him out for a beer one time, and the entire fundraising process, I was texting Austin Allison, being like, hey man, what should I do here? Like, what do you know about this fund and that sort of stuff? And I couldn't help but feel like I was kind of like a leech to him. And honestly, I don't think he really liked texting me back, and like he would like delay, and I'd always be like, can I get on the phone? Maybe. And I felt like I was always kind of like stealing people's time. Just because it felt like he was aware of some world here. I wasn't in that world, but I was trying to get in there. And so I have a theory right now that there's a little bit of a gap at the seed stage of there aren't a lot of resources of people who have actually raised venture capital that are helping people at the seed stage raise venture capital. And I feel like once you get to like Series B on, they're investment bankers and their processes and that sort of thing. And I think the reason is because there isn't really a great business model for helping people at seed stage. And so right now, quite honestly, I'm exploring to see if there is a business model of helping people at your stage. And so right now what that's looking like is I'm creating some content. My friend Alex is filming today. Creating some content, not to get money for the content, try to give away all the content in the talks and be as helpful as possible. And then I've got a couple companies that are paying me a small retainer to get on the phone with them once a week and coach through, look at emails. I can respond to texts and emails and that sort of stuff as we go. And so far it's been super fun. And I think it's like, I'm kind of being that Austin Allison without all the guilt in that. And so if that's of interest to you, this is my way of kind of putting out feelers to see if there's a small business here. And what's cool is that I also have some relationships with VCs, and so there's like a cool, I don't know, there's a way that I think there's some model here for an individual to maybe make a small business in this thing. But your feedback on this would be super helpful because I am exploring right now. Yeah, so that's why I'm doing this. But I do really care about everybody's journey in this process, and so that's another reason I'm here is because it's not for the faint of heart, as we were just talking about. You find out who you are in this process. So, all right, here's the big thesis of the day. This is a quote that I found from Edward Demings. He's an engineer and a management consultant. And it says, if you can't describe what you are doing as a process, you don't know what you're doing. And I think a lot of us as entrepreneurs, when we try to raise money, we have no process. It's literally like you hear tips like always be fundraising, always be pitching. And we're just kind of like anybody who wants to talk to us, we just kind of are grabbing our way through. And that is not a process. That's chaos, and it will drive you crazy. And so we definitely started in that chaos side for sure. And the difference in terms of terms, in terms of speed of getting fundraising, and in terms of outcomes is way better when you actually run you conduct a process. So all of today's gonna be talking about that. An example would be like, I was thinking, Everett and I have been getting really into chess lately. We've been playing a lot of chess. Are there any chess players here at all? Yes? And so there's a big difference. He's playing this app called Dr. Wolf. It's like a little chat bot that like gives you coaching as you play. And I've noticed him kind of getting into, like he's actually finding some processes, like he's thinking about how the opening is played and like how to trade material in the middle game and then actually like having some formalized how to end game. And there's a big difference in terms of like suddenly he started beating me a lot more easily when he started implementing an actual process as opposed to just trying to be smart in play, right? And at this point, so far, I think I'm still smarter than Everett at this stage. But he's been able to beat me in chess because brains are no match for a process, right? And emotion and vigor and all those things are great, but compared to a process always will win. So that's what I really want to focus in on. I'll give one small example. We didn't run a process when we tried to raise kind of like it was like our first institutional, but it was regional institutional round. We raised, I think it was $750, and we had Cincy Tech and Queen City Angels both kind of on the hook, but they were kind of the only two real players in the region that were both interested. And I thought I felt pretty good because we had a term sheet with both of them participating. And so of course, thinking that I'm really clever, I was like, oh, well, maybe I'll try to play them off of each other and kind of raise the valuation a little bit, which worked great until one of them backed out. And as soon as that one of them backed out, I found myself running a single-threaded process with one investor. And guess what? The timeline got way slower, the terms got way lower, and I found myself underfunded because really I didn't know the dimensions of actually creating tension in a system. I wasn't running a process. Compared to our last round of funding, which we just raised right before we sold the company in August, literally sent out an email, described this is how much time we have, these are the terms, and this is how it's going to be used. And literally we were funded in 4 days. That is an abnormal outcome, and I think it's just because last money in a moderate exit is a good place to be. You don't want to be first money in and a great exit is where you really want to be. But we weren't a great exit, so last money in is a good spot to be. But we were able to close really quickly because I knew the mechanisms and levers to play, specifically time bounding it, also making sure that I'm blasting it out to multiple people at the same time and making it a finite amount that they would have to fight over. So that's what we're going to be talking about today. All right, first, before we get into that process though, a little bit of context. Context number one. Nothing is a replacement for being a healthy startup. This is super important. We're going to talk about fundraising. We're talking about VCs. Your job as an entrepreneur, first and foremost, is to build a healthy startup. It is not to raise venture capital. It is not to get in some password-locked article on Cincinnati Business Courier that says that you raise this amount of money. Our job is to actually is to build a healthy business. So what is a healthy business? I think anybody who's in accelerators is probably covering something like this. You want to have a growing market, right? It needs to be a big and growing market. You need to have a killer team. You need to have an amazing product. You need to have impressive traction. You need to have an economic moat, which means it's hard for others to get into it. And I would say if you can score yourself objectively, score your business, when it's time to raise money, you really want to be in the spot where you have, like on a scale of -3 to +3, you have nothing below a 0 on this chart, and everything, maybe 1 or 2 +3s. You need to have like one of these has to be shiny, and you need to have none of them be bad, and you can probably raise venture capital. And so I kind of like that idea of like just score yourself on a +3, -3. If you have +3s on all of them, you don't need a fundraising process at all. Money will find you. If you think about Facebook, like what was Facebook like? Growing market, absolutely, like social media in the early 2000s. They had a killer team, and that they had Peter Thiel and they had Sean Parker, both like right at the very beginning. You had amazing product in that they had 80% daily active usage. 80% of the people who used Facebook, who signed up, they used it. If they signed up that month, 80% of them used it every single day, which is just unheard of. They had impressive traction. They had over 1 million users before they even raised any money. They had an economic moat, and that they had network effects, right? So every time a person joined Facebook, Facebook got more interesting, which made it really hard for somebody to kind of dethrone them, right? And so that's the reason why they went to 3 meetings and were able to close a tier 1 VC, is because they had +3s on all of these. So absent of any fundraising process, the number one thing you can do to make this process better is you build a good company. And I think sometimes we get a little bit backwards where we start celebrating venture capital way too much. And there's actually, I think, some reason for that, which is that venture capital would like to be celebrated because that makes them more attractive and it makes us all kind of line up out the door. But as entrepreneurs, we all know that their venture capital it's a credit card, right? And like we don't celebrate as a family. We don't celebrate when we get approved for a new credit card, right? That would be kind of weird. Like we finally did it. We can get $10,000 of credit. Like as a family, you focus on what are we going to do with that money? What are we going to accomplish? And that's our job as entrepreneurs, is to actually accomplish building something significant, not to get approved for more money on really bad terms. So, all right, next up, not all our investors, again, we're talking about context beforehand. Not all our investors are the same. I want to talk a little bit about motives and where we can get money from. We kind of did the full gambit with our company. So first off, you have friends and family. The equation for getting investment from friends and family is have a good reputation and be willing to ask them for money. And if you have those two things, you can raise, I'd say, somewhere between $250 to $500K. And you don't have to come from money. Like most of our money did not come from family. It came more from friends and just like people that I'd worked with in the past. It honestly came from people who introduced us to other people. And this is just pretty much sheer will. And the willingness to put your reputation on the line. It does make Thanksgiving incredibly awkward for a very long time. I still have some awkward Thanksgiving conversations because I ask friends and family for money. But if that's what you have to do, that's what you have to do. Next up in the food chain is like more angels and strategics. And I'd say the equation for that is more, do they believe in the future that you're painting? And do they have an interest in the industry that you're in? And if they believe those two things, I think you can raise somewhere between 500 to $1 million in that process. And I'd say that you need to run more of a formal process in that. Next up, you have seed stage VCs. This is when I'd say we have a true like institution who typically those people have taken money from family offices or sovereign wealth funds or something like that for the purpose of investing in high risk startups. And so with them, I'd say the bar has changed a lot. It's less emotional. It still is emotional that you have to have some wave of momentum behind you. That at seed stage can be a lot of different things. It can be a new hire. It can be some piece of traction. It can be a lot of different things at seed stage. And then also one key performance indicator, one metric that is, I would say, absolutely impressive. So like that daily active usage metric for Facebook, that's an impressive metric. Yeah, does that make sense? And then finally, Series A and beyond, that's when you're going to have actual milestones, which is not just do I have a cool engagement metric, but I'm above $2 million in revenue, right? There's some like absolute milestones that you have to hit, as well as KPIs that support underneath that. So it goes from like being relational and emotional to toward the end, it starts to feel almost more mechanical, if that makes sense. It feels like you're getting a mortgage or something like that. Does that make sense? Good? Yes? All right. Next, not all define success the same way. This is my last piece of context that I think really is important. With friends and family, if you can double their money in the course of 7 to 10 years, they're going to talk about it at Thanksgiving, be like, yeah, doubled my money. Like they're going to feel pretty good about that. That's a very low bar. And so when you think about outcomes for your business, pretty much anything doubling the business and beyond, they're going to be incredibly happy with, which makes it in some ways friendlier money, right? An angel or strategic investor, if they can get 5x their money, that's a great use of funds. 5x your money in 5 to 10 years. What is that? That would be from an IRR. That's like a 15 to 20% IRR. Like that's a really solid return, and they're going to say that's better than the stock market. I feel really good about that, right? Then you have to look at venture capital, and this gap, it makes it look laughable because the sizes are so different. Venture capital is a weird equation, and is everybody familiar with like the math of venture capital? Nod, yes, no, yes, okay. So the math is really weird in that they've taken money from family offices or from sovereign wealth funds or from individuals who are incredibly wealthy. And so they have maybe a $40 million fund. And over the course of 7 years, they're going to invest in 10 different companies. Of those 10 companies, 8 of them are going to die within 3 to 5 years. So there's only 2 companies remaining. Those 2 companies have to make all the return for their investors, right? So over the course of 10 years, those 2 companies need to each provide 100x return. If they do 100x return, that will give them a 30% IRR for their investors, which is kind of the most risky sector of investment. So if you start thinking about it, if you're pitching to a VC, and let's say you're raising at a $10 million valuation, and you're like, I see a very reasonable path to us getting to be $100 million. That sounds like a pretty good pitch. But to a VC, they're like, wait a second, that's 10 times my money back. If you're only 2 companies are going to be successful, if you're only 10 times my money, I'm not going to even be able to return the funds to my investor. They need 100 times their money back in order to actually make the mechanics work, which is why you see VCs tend to be incredibly aggressive about dumping more money in because they really do need that outcome in order for the entire thing to work. And I think that that's where sometimes in the Midwest specifically, I think we're thinking like an angel investor, and we tend to think like, hey, who wouldn't want to make 10 times their money? And the answer is these people would not like to make 10 times their money. They would like to make 100 times their money. And that's just that is the nature of the relationship, and it's important to know that. Knowing that, for especially these 2, the price at which you raise money, therefore, is a lot less important than you think it is. Because if you're raising money at a $10 million valuation right now, and it's very risky, or they wait and you can raise it at a $20 million valuation, that's a much better deal for them, because the difference from $20 million to $1 billion, it's negligible in terms of like that amount of the gap between the 10 and the 20. Does that make sense? So mathematically, it doesn't make sense. Great, thank you. Mathematically,
no, it does not.
All right, so if I can get, if I'm going to get 100 times my money back, right, versus even, and you're going to be trying to get to $1 billion company, right? If you wait a year to make that investment, and maybe the price goes up a little bit, but we're more sure that it's going to happen from a risk standpoint. After that year, you've de-risked the company. That is a much better outcome than to get in early at a lower price and then the company fails. And so mathematically, the right answer for any investor, always in relating to your startup, is to wait. That is the mathematical, risk-adjusted best move that they can make, is they should wait. They should not invest in your company. They should, absent of anybody else acting, they should just sit and watch until you've de-risked your business to the point that they're ready to invest in it. That's super important to understand, that that's not being cowardly, that's not being like, I don't know, lame. That's actually just the mathematical right answer. And if you meet an investor who's like, I gotta get in now early, they're probably not a great investor, because the best investor should want to keep this relationship going, but it should want to wait as much as possible. The problem for us is we don't have time, right? We don't want to wait. And so our job, and this is really the rest of the process that we're going to focus on, is how do we make it riskier for a VC to wait than it is for them to invest? Because otherwise, absent of anybody else being there, they're going to wait because it's the mathematical best thing to do. I feel like I was a little foggy as I explained that. Did that make sense? Everybody feel good about that? We're hanging pretty much the rest of this presentation on this concept of, so I want to make sure everybody understands. So yeah, to reiterate, waiting is the right answer unless you do something to make waiting the wrong answer. And so how do we do that? So this is the process that I would recommend. A good fundraising process, first, you have to create a wide funnel. You have to have a lot of people, because suddenly, if you know that you're not the only person talking to this startup, suddenly you have to actually know that you're competing with other people, other money, and that means that now there's a risk that you might lose the deal. Two, you have to run incredibly dynamic meetings that are calculated. We're going to go through minute by minute how to run a good investor meeting for the first one. And then finally is you have to keep selling all the way through the close. And really, I'd say the dynamic in all of this is you're trying to signal to the investor that they are not that special, they're not the only one that you're talking to, and that you don't necessarily need their money, and that you are continually talking to other people throughout the entire process. And if you can do that, suddenly you actually can turn the tables toward your side where there's a lot, there's more tension until you'll get better terms. All right, cool. Let's jump into it and get some examples. Great. First off, let's get a lot of, create a wide funnel. And the way to create a wide funnel is you need to get a lot of strong introductions. What do I mean by a lot? This is my hit ratio. My hit ratio was for every one introduction I got to a venture capitalist, that was worth $10,000 in my actual round. So when we were raising 1.8 million, I had to talk to 180. I had to get 180 introductions to venture capitalists. That was my hit ratio. I hope your hit ratio is way better than mine, but that's what I found to be the case. All right, what is the actual process of doing this? You have to actually, you have to create a pipeline. You have to create a list of a lot of investors for you to talk to. So how do you do that? I actually have a spreadsheet. I'm not going to open it up now. I have a spreadsheet. If you want to, afterwards, you can go to my website, it's allsmith.org, and you can ask for all the resources. I have a couple spreadsheets and stuff that I'm happy to share with you. But you create a spreadsheet of a pipeline of potential investors to talk to. And the way you're going to create that is, I like to do it through, you're trying to find investors who are really interested, are naturally predisposed to be interested in your business. So one way you can do that is look for people who've invested in companies with a similar thesis to yours. So for us with Cladwell, one of our theses was that we thought that minimalism was going to be a really big trend amongst millennials. And so I found a startup in Chicago that they also believed that minimalism was going to be a big deal. And they were, they were doing storage for people who lived in cities. People could store their excess things in their house, like their bike and stuff like that. Because they're like, oh, people like to have a clean, minimal space, and so they're going to do that. Our company was a fashion company that focused on minimalism. So they were completely non-competitive, but both had the thesis that minimalism is a big deal. So I literally went to angel.co, you typed in the name of that company, looked at all of their investors and pasted them into the sheet. And so I had probably 12 people on my sheet because of that company. And so then I had to find introductions to those people. But I knew that when I called them up and said, I think that minimalism is going to be a huge deal for millennials, they're like, got it. I agree with that because I've already invested in this company. I would like to hear more about this, right? So they're already a little bit educated. Second, you can do the same thing with having a similar business model. For our company, we were a subscription app. And so what did? We went to all the other companies that were subscription apps and went to their investors and said, hey, you invested in Headspace. It's a meditation app. We're a fashion app. We're like Headspace, only in that we're subscription. Same sort of funnel and design, but a completely different industry. And so they were happy with this app over here. They're going to be happy with us. So they're already positively predisposed. And then finally is looking at people with similar background or with a predisposition to liking you. Maybe if your college has maybe an investment fund that invests in alumni. If you're, I don't know, weird religion or ethnicity or anything that puts you into a niche that people say like, ooh, we like to invest in these types of people, absolutely put those people on the list. I had a 10 to 20% hit rate with Christian-focused venture capitalists. Because I'm a Christian, so of course I went to all the Christian-focused VCs, and I pitched all of them, and I was way more successful with them than others because they're like, oh, this guy's a Christian. He's in a small group of people that are doing this. One caveat, I would say, be careful if you're going to use your religion as a part of how you raise money, in that it can feel a little icky, and you have to be a little careful, because the only thing we have left is our souls in this process, and if you sacrifice that thing, you're in real trouble. So yeah, but the main point here is I've found most people, when they're raising a seed round in the Midwest, they think that they're doing really well if they pitch 25 companies. And then they're disappointed when they only raise $200,000. But that mathematically is what I would expect for pitching 25 VCs. You need to pitch more like 200 VCs. And that's a difficult process. The next piece of that process is you need to get really strong introductions to all these people. You cannot cold call a VC, as I'm sure everybody's probably heard that at this point. You really should not be cold calling VCs. Instead, you need to actually get a strong introduction. Who's a strong introduction? A strong introduction is anybody who has a halo around them. The strongest is always going to be an entrepreneur who's made that VC money in the past, right? That person has a halo, and they can walk in and say, hey, I made you money, this person's going to make you money too. And that introduction is gold. And so those relationships that we have with each other are incredibly important because that halo can be handed over to somebody else. So you've taken your list, you've got your pipeline of 150, 200 VCs. You're now going to probably pay somebody on Fiverr to look through your LinkedIn and find out how you're connected to all those different VCs. Or you're going to network around, you're going to share it with your friends and ask for people to make introductions. This is an introduction, and it is very pixelated, so you cannot read exactly what it says. But the general structure, there is a structure. I linked to it in here. There's a structure for how to get an introduction to a VC. This is a cultural thing. We are entering into a finance culture. This is not a creative culture, but it is a finance culture, and we're jumping into this. And so there is a formula that VCs expect to get for an introduction, which is, let's say that maybe you want me to introduce you to Mike Jones from Science. So you're going to say, hey, Blake, thanks so much for offering to introduce me to Mike Jones from Science. I really appreciate it. Let me tell you a little bit about my company. Here's a short summary. Here's a shiny piece of traction, another piece of traction. Here's what we did previously in our previous career. Here's a vision thing of how big the market is that we're going after. And finally, I'm really interested in talking with Mike Jones because I saw that he invested in Bird, and they have a similar thesis to us. And so that's why we'd really be excited to talk. Best, whatever your name is. That is the formula for a blurb. This is called a blurb. You need to follow this formula. You're going to forward that email to me, and then I'm going to forward it over to Mike, and I'm going to say, hey, Mike, here's an example, or here's this founder, love this person so much, super interesting. I'm going to enthusiastically hand my halo over and say, would you like to meet? And then if he says yes, then we do an opt-in introduction. This is it's so dumb how culturally rigid this culture is. But we really have to stay within here. And I think this is, we were talking about this earlier. This is where I think a lot of us as entrepreneurs go wrong. Because when we're presented with an established way of doing things, the natural reaction we have as entrepreneurs is to try to buck the system and do something creative or different to set ourselves apart. And that gut is entirely wrong when you're trying to get a mortgage. Right? If you're going to try to creatively get a mortgage, the banker is going to say, please leave. We don't want your creativity. We just want to see your debt to equity ratio. This is closer to a mortgage process than it is to a really creative process. And I think that's where we kind of sabotage ourselves very often. So there is an established culture. You actually need to write the blurb. It's specific to each VC you want an introduction to. You forward individual emails over to a founder or whoever's going to make the introduction. They forward it over, mutual opt-in, and hopefully you're going to be setting up an actual live meeting in the city where the VC is located. So with that list of in your pipeline, you're going to batch them by city. You're going to do 2 weeks per city, and you're going to try to do 4 pitches per day. So you're going to, 2 weeks in advance, ask for the introduction and say, hey, I'm going to be there in 2 weeks. For a 2-week period, can I get coffee? And so that's the next step that you're going to be asking for is, can we get coffee together? Make sense? Am I moving too fast, too slow? People feel good? So I feel like I was saying at the principal level. We'll try to get more stories. All right, next, we need to run some dynamic meetings. You got the coffee meeting, congratulations. In fact, you didn't just get 1 coffee meeting, you have 4 coffee meetings a day for 2 weeks in Silicon Valley. And they're split, unfortunately, between Silicon Valley and San Francisco. So you're driving frantically back and forth trying to make 4 meetings a day for a 2-week period. Congratulations, that's a good sign. Now we need to know, how are we going to run this meeting? It's just coffee, right? You're going to be meeting at a coffee shop typically. You'd think I can just kind of very authentically share about my business. No, wrong. Do not authentically share about your business. This is a formal, strategic chess game disguised as something that you do with your friends on a Saturday and get coffee, right? But this is actually incredibly formal, and you need to be the one in charge. So as the entrepreneur, this is the structure that I personally used and kind of developed over time. There's jackhammering outside. This is great, yeah. Yeah. All right, so how do you run a pitch? This is literally minute by minute how I conducted my pitches personally. You don't have to do it this way, but it did work for me. Can you guys hear me while I'm talking over this? No? Yes? That's unfortunate. What do you think we should do? I don't know. Is this going to be happening for a while? All right, I'll just try to shout over it as much as possible. Oh my gosh, yeah. Yeah, I'll try to do that. Okay.
I would imagine that way your camera.
If it's any better, yeah, we'll see if we can do it any better here. Yeah. Say again?
Maybe we'll get a siren and drown it.
Yeah, that would be helpful. Yeah. Okay. Yeah. All right. So minute by minute, this is kind of how I picture it. This is what I stumbled into. First 5 minutes, be a human being and talk to other people, right? Talk to the investor as from one human to another. How's your day going? Where do you live? Do you have children? Like, how's this coffee? Let's talk about our mutual introduction. Be a human being. That helps a lot in your establishing trust. After that, you're going to ask some very specific questions, and these are very calculated questions that you're going to actually use to change the way you behave after you get the answer to these questions. So, first off, what's your background? You need to understand who the investor's background is, what their role is in the organization. What's their specific investment focus? What's the thesis of the fund? And you're taking notes on this because you're actually going to position your company differently based on what their thesis is. So like as a fashion company, if I came to somebody who was really interested in AI, I'd say we're a technology company that's first application is fashion, right? But if I went to Forerunner Ventures, who focused a lot on fashion, I'd say we're a fashion company that's backed by technology, right? And so you're going to change the way you position yourself based on how they answer these questions. And then I'd say one of the other huge questions you need to ask is the decision-making process for the fund, which is, the way I phrase it is, assuming you absolutely love our business today, and we're going to, and everything's a full go, what happens next? Can you walk me from now until cash in the bank with us? Who are the decision makers? When are those decisions made? When's your partner meeting? When are we going to follow up? Am I going to come into the office and actually get a timeline from them? You're going to write that timeline down because you're actually going to use that to then follow up with them step by step. You can hold them accountable to the timeline that they outline. Does that make sense? Cool. Next, then you're going to pitch. You're going to use your slides. If you don't use your slides, what you'll find yourself doing is halfway through your presentation, you'll be asking yourself, did I already tell him this, or was that the last meeting an hour and a half ago? And you get completely lost and confused, which is exactly what I did. I was pitching somebody on Sand Hill Road, and I didn't use my slides. And afterwards, the guy was a definite pass. We were way too early for their fund. And I said, hey, honest talk, since you're not going to invest, what should I do differently? And he goes, why didn't you use your slides? I was like, I don't know. I thought it was like a more authentic way for us to communicate. He goes, no. He's like, it makes you look like a total noob, and I didn't know what you were talking about the whole time. He's like, use your slides every time. And I was like, man, that was really helpful. I was thankful that he was honest with me. So you're going to use your slides, and this is an opportunity for you to show your passion about your company, right? You're telling a story. Last, I like to put people on their heels a little bit right immediately afterwards and ask a couple additional questions, really asking them to kind of prove how they're going to be helpful. Sometimes that can be a little overplayed, so I'd say just based on your level of comfort with that. Last 10 minutes, what questions do you have? You now have 10 minutes of somebody who probably went to an Ivy League school, who's looking at 9 companies a day, 5 days a week, and they have a huge amount of context on your industry and on what's getting funding and stuff like that, and they're going to give you their criticisms of your business. This is incredibly valuable. They're not trying to be mean. They're not trying to neg you or anything like that. This is actually an incredible, valuable piece of feedback. So you want to actually ingest this stuff and try to learn from it. You also want to answer any questions that you possibly can. But a lot of times I think entrepreneurs get defensive at this. Sometimes they're actually going to be putting out challenges to see how well you've thought things through. Or they'll be putting out challenges just to see how collaborative you are. And then, this is the most important part, which he's doing right now, which is leave. After 45 minutes, you have to walk out the door. You have to end the meeting. If you're watching the clock and you are saying, all right, I'm done, thank you so much for your time, I'm going to leave the meeting, that's signaling to them that you have other places to go. If you just keep blabbering on for an hour and a half, wasting their time, it's going to get incredibly frustrating to people. And it also shows that you're desperate. So that's a big deal. All right, next, let's talk about how do you make it dynamic. I just can't emphasize enough, this is performance art, and the big question that people are asking about you is, are you the person to run a 1,000-person company, right? So they're wondering that, and so you need to actually act like a person who's running a 1,000-person organization. And this is a performance, and so it's less of trying to understand who you are, they're trying to understand who you could be, and so you have to kind of polish this in a way to make them get that sense. You need to have a great pitch deck. Just Google pitch deck structure, startup, seed stage. Guy Kawasaki has a 10-part slide deck. You're going to use that, and then you're going to polish it regularly. The last part is, this is a bit of a rinse and a repeat process. Can you guys hear me back here? Are we okay? It's a rinse and repeat process, which is you need to do 4 meetings a day. Every night you need to do follow-ups to equip people for their partner meetings. And then finally, every Sunday, you need to actually rework your deck to say, did that story work? Where do people get confused? Well, how can I change it? And then also add appendix slides to answer people's questions. By the end of this process, you're going to have like 60 slides in your appendix and 10 slides that you've changed 100 different times. But there's kind of a cadence to that, which is like meet all day, follow up all night, every Sunday make changes and implement to make more slides. So, cool. All right. Cool. Finally, let's talk about selling through the close. First off, what are we talking about when I mean the close? This is what due diligence looks like. You're pitching all day, every day, and you're getting no follow-up from anybody. And suddenly you get an email that looks like this. And this is from Jake. This is literally what this guy ended up leading our round. Literally, you can see bullet point 1, 2, 3, 4, 5, 6. It went down to 12 different questions of specific pieces of data that they were asking us for. This is so bizarre looking when your inbox is filled with, hey, thanks so much for meeting. Here's maybe one follow-up question, or unfortunately, we're going to pass. And then all of a sudden you get this email. This is what due diligence, you're getting into King Koopa's castle at this point if you start to see a lot of detailed and I'd say increasing in speed questions. And so that's what you want to be looking for. And the way you answer these is incredibly important. Things that you need to do in this process as you're starting to get into close, you have to have all your data ready to go, and you need to know it forward and backward. 2, each of those questions is really more of a jumping off point than it is something you have to answer specifically. You can be a politician, right? That's a great question, but you should have asked this, and then you can jump immediately into it. And then finally, everybody has something at seed stage. Everybody has something icky about their startup. Like, we all have something that we wish were not the case. And if you didn't have something icky, you wouldn't be in the seed stage. So you don't have to feel bad about that. But the way you address the questions around that icky spot in your company, if they're a good investor, they're going to find it. The way you address that question matters immensely. I can remember our icky thing when we were raising our first round in Silicon Valley. Our icky thing was our churn. So we had a subscription business, and 10% of our customers stopped paying us every month. That's very high. If you compound that, we pretty much had to replace our entire customer base every 14 months. That was problematic. That was icky. And so any good investor would suddenly start to look at the churn numbers and say, wait a second, how are you going to solve this? That's a good question. That is an educated question. So for the longest time, I would list out, here's all the tests that we're planning on doing, and we think that on average, we'll improve it by 2.5% each, so we just need to do 4 of these things and then it'll solve it. I answered the question, and without fail, every single time they would say no after I answered that question in that way. And so it started to feel like a trap. And I was starting to see this pattern where every time they brought up this question, I knew that a no was coming immediately afterwards. And so I started to get really pissed about it. And so finally, that group, Sovereigns, who ended up investing, it was like several meetings in, he goes, we need to talk about churn. And I said, do we? And I just got kind of mad about it. And I said, look, I have no clue how I'm going to solve the churn problem, okay? I know you're going to ask that, but the truth is I can give you a list of all these different ideas I have, but I have no clue if they're going to work. But do you know what I do know? I do know that I'm a person who can solve problems. So what was my last problem? That's a better question. My last problem was our cost to acquire a customer. It started off up here at $50 and we lowered it down to $20. How do we do that? In 1 month we did 20 different tests. We did this, and then we solved the problem. Do you know what I solved before that? I solved our revenue problem, and then we talked through all those different tests. So how am I going to solve churn? I have no clue how I'm going to solve churn. But I'm going to solve it because I'm a person who solves problems. And the big question you should be asking is, how am I going to solve the problem after the churn problem? Because that's probably the one that's going to kill us. And the truth is, the only way I know how to do that is because I've solved problems in the past. And I was like mad. And they go, okay. And there's this next question. I was like, that's all I had to do. It was like, but the way you address the answer to that question actually makes, in my experience, it makes the entire difference as to whether you're going to get to the next phase or not. Does that make sense? Yes? Cool. All right.
Does that relate one-to-one then with what you were talking about, being in charge, being confident, and this is what we're going to do?
Yes, absolutely. Yeah. I think you really do have to. Again, I don't think people like ambiguity, and it feels unsafe. So yes, I think you have to just kind of, this is what I think, and this is where I'm going, while also being willing to take coaching, but also be really clear about what you intend to do. Backup plans don't tend to resonate very well, is what I found. Yeah, so this is the entire process as I see it. You got to create a wide funnel, right? You got to get a lot of strong introductions. Second, you got to run really dynamic meetings, which is performance theater, right? And then finally, you got to sell all the way through the close, which means that you are never just giving an answer to a question. It's a diving board to kind of launch into your platform as to why you're an investable company. So, I think lastly in all this, let's talk about pitch number 144. I literally pitched 144 companies, VCs in a row. While we were living in San Francisco, we went out to New York for 2 weeks, went to LA for a week, went to Austin for a little bit, and to Chicago. And it was our last day. We had to move back to Cincinnati. We had 0 yeses. And it's literally the last day. I have a breakfast meeting, and it was an amazing introduction. This guy who introduced me was Kirk Perry, who's from Cincinnati. He was a P&Ger, was a chief brand officer at Google. He made an introduction to this VC. So it was I'm coming in with a halo. It's my last day. It's pitch number 144. It was in Los Gatos at the something like Little Bear Cafe at 9 in the morning. Walk in, I have the halo. We connect as people together for a little bit. I then go through and I start pitching. And at the end of the pitch, he leans forward and says, hey, I know you're leaving soon. Would you be willing to meet with my partners at lunch today? And I was like, oh my gosh, this is happening. I said, absolutely, sure. So we ended up meeting at lunch. I ended up meeting with the principal and the associates and got on the phone with them that evening, stayed out till 10 o'clock that night, and we had a term sheet within a week. And it literally came down to pitch number 144. They came in. So from there, once they were in, I re-looped to a bunch of people who were still considering. I said, hey, I know that you were interested in doing $500,000. We just got $1 million in, so unfortunately, we can only take $250 from you. Let me know within the next 2 weeks. And then suddenly, it was 144, 45, 46, 47, 48, and we closed the round of funding. And it was such a crazy thing that if I hadn't gotten to that number 144, we wouldn't have actually closed the round of funding. And that's, I think what I want to leave it with is that, like, a lot of this is, if you just continue the process and continue running it and trust the process in this, you will raise the money, because as long as you're changing your story and actually taking the feedback, your company will improve, your pitch will improve, and you'll begin to the process will result in getting funding. So I don't know, I really care about this. I feel like you learn a lot about who you are as a person in this process. So if you want to talk further about it, I'd be happy to talk afterwards. Again, if you want, you can go to allsmith.org, just put in process 2020 as the code, and I'll send you these slides that has the outline for the pipeline, a blurb, and all the rest of the stuff. So that's it. Any questions that you guys have? Yeah. Cool. Great. Yeah.
Where did you get your money to live?
Where did I get my money?
While you did 144 pitches, where did you get your money to live?
Yeah, that's a good question. He asked, where did we get money to live while we were raising money? We went to the through an accelerator called 500 Startups. They gave us $125,000 for the 4 months that we were in that accelerator. We also had some revenue coming in, so those two things together of like relying on some revenue. I think at that point we were doing maybe 75K a month in revenue. We had a pretty high burn rate, but then also we had some cash from 500 Startups. Yeah.
Fantastic. I asked everybody who would raise money.
Yes.
How many people would raise money?
How many people are raising money?
Don't have raised money.
It seemed like not a lot of people. How about who has? You're asking who has raised money?
Yeah.
Who has raised money here so far? There's a couple. Yeah.
Because if you could you focus a little more on the front side? Because those of us that are in the on the angel friends and family, the process there.
Yes.
Because all this other stuff, right? We're not even.
Yes.
We gotta get that down first, right?
Yeah. So he's saying
Your success in that area, how you got individuals
yes.
to get on your cap table,
Yep.
buy into you, and believe in you, and all that up front,
Yes.
prior to getting to the VC shuffle.
Yep. I would say literally the same dynamics. These are human evolutionary dynamics play the same part. It's literally just that you have to do more pitches with more angels, right? So with angel investors or strategics, you still do need to say, do they have an interest in my area? Have they invested in this area before? Do they have a predisposition to liking me, right? And so it's really, I think it's the same sort of dynamic and it's the same sort of process. The only other difference is with angels, you can close an angel right now in the meeting.
Right.
So literally, if it goes well, you can say, cool, here's the paperwork right here. I always kept the convertible note or the safe actually in my back pocket. That's the other thing is you establish the terms at angel side.
You're right, yes. So the question though is for us in Cincinnati
Yeah.
and the West, because we don't have 10,000 angels around.
Yeah.
How did you develop your list other than the 2 angel groups in town?
There is nobody more interested in investing or in sharing about your company than the person who just invested in your company.
Right.
So as soon as you close them, say right now, who are 5 people who you think might also be interested?
Right.
And then literally have them text right then those 5 people and we're going to do follow-up invitations. So you're going to actually work the network through that.
Right.
Also, if somebody declines, depending on the reason they decline, they can still introduce you to more people. But I did not know everybody on my cap table relationally. Some of those came through introductions from other people. And so I'd say leverage the power of the angel phase versus the VC phase is they don't have an established decision-making process.
Right.
So you can close in the meeting and then get referrals immediately. And so you can actually, I think you can raise that money faster in a lot of ways.
Right.
But it is different in that sense.
Yeah, I just found that to me would be most helpful for those that have not raised locally.
Yes.
Is to learn that process,
Yeah.
because that gives you the ticket then to go talk to the next stage.
Yeah. Yeah. No, I'd say,
Because the thing we found in all the years I've been trying to do, I've been doing this,
yeah.
is that we don't have angels in Cincinnati. We have angel groups, right? So there's no real organized way.
Oh, I disagree.
Well, that's my that.
Yeah.
Okay, then
Austin Allison raised 2.5 from individuals outside of Queen City Angels.
right.
Queen City did not invest in that.
That's my
Yeah.
question is, how do people get access to those people?
Yeah, he was a real estate agent.
Right.
And so he knew that the name of the game is just pound the pavement, right? And so he worked that network. He got into some weird groups in Indian Hill that they're like, oh, you got to meet this person, you got to meet this person.
Right.
A big piece with angels, as we're talking about this, another dynamic is that they want to invest in somebody that they can see themselves in you.
Right.
So anything you can do to find from an affinity group standpoint, or honestly just mirroring of like, oh yeah, I'm into that sport also, I'm into the whatever also. Any sort of feeling you can get with that makes a huge difference.
Right. There's like Allison, like me, like you.
Yeah.
There are some of us that have that natural market
Have that natural market.
of successful business people that have money,
Yeah.
right, that we can go to and sell our idea and create an angel.
Yes.
On our own. My question is, how can we as a community though, broaden that for folks that may not have that? They may have the greatest idea in the world, but they don't have that natural market like Austin did. and what
Yeah.
you do and
We got to
what-
share our halos, right? Like if you've got a halo,
Right.
It's our job to, if you see an idea that needs to be funded, I think it's our job to try to do that together. And I think that, I mean, the truth is that I was a homeschooled kid in Cincinnati, Ohio. So I already had a natural stab against me, which is that people would say, what school did you go to? And I'd be like, I was home. And like, you're pretty much done at that point. What else? Yeah.
Did you participate in any pitch competitions?
Did I participate in any pitch competitions? Yes. They're a great way to meet other entrepreneurs. That's it. Yeah. And do them. Like, that's a great way to meet other entrepreneurs. Yes. It is not a way to make money for your business. Yeah. Yeah. But do them. Yeah. What else? Other questions? Cool.
You didn't mention anything about the elevator pitch. How
The-
important is that?
Oh, the elevator pitch? How important is that? Yeah, I mean, at every party, at every if people say, like, what do you do? Absolutely. I think you need to have that in your back pocket.
What was it, out of curiosity?
My elevator pitch? I don't know. I feel like I worked so many iterations of it. I'm trying to think of like the best. I feel like we all kind of fall into a rut of how to do it. I think that sometimes you can look at those formulas of how to do it. I liked the idea of like a one-liner that then if people wanted to ask more, they could. And so then it was like more of like a clawing into it as opposed to like a full paragraph. Sometimes it just felt like, especially in like the Valley, everybody's doing it constantly, that it starts to feel a little much. So I think toward the end, I just said like, we have an app that dresses 250,000 people every day. And it's like, oh, interesting. Like people's like, how do you do that? And then it's like, I'd pull it out and just walk them through it. Yeah, that's a good question though. Yeah. Any other questions? Thoughts, comments, feedback? Any like things you liked about this presentation? Things you wish were different? Things that maybe you wonder that maybe I missed? The one wonder of like, oh, we should talk specifically to the early stage. That's a good feedback.
Yeah, it was great. I'm early stage, so that was like deer in the headlights, what might be coming.
Sure. Yeah.
So it's great.
Yeah.
I love your narrative on the icky thing.
Yeah.
How you address it, it could come from anywhere, it could be anything. Do you have sort of in your head, maybe this is an unfair question, but sort of the top 5 hardest questions that you get that seem to be the most consistent, or top 3, but top number 1?
Yeah.
Seem to be the most consistent things or questions when you have these interactions.
The hardest questions, yeah. Normally, the basic question is every investor has a framework in their head of like a checklist that they're going down. And a lot of times it's like those 5 things or some iteration of those 5 things of like, okay, so how big is your market? The really hard ones for us, most of them end up being specific to your company because they're like one of those truffle finding pigs. Like a good angel or a good VC is like a truffle finder. They're going to find the truffle. They're going to find the spot that's the hole. We got boxed in with, because we were female focused and millennial focused, we got boxed in as niche really early. And so they'd be like, how big is that market really? And that's kind of like a little bit of a checkmate. And so I ended up establishing in my first slide, I'd say, obviously, I don't have to justify to you that this is a massive market. And I would say that to start, and then I would just give the same stats. But I would just say, obviously, I don't have to justify that this is a huge market. And people would be like, yeah, that's right. Yeah, obviously, you don't have to. Which I thought was hilarious that was, yeah, so that was a pivot for us. Other really difficult questions. People really like to know the why you. And that, I think, is really difficult for us as Midwesterners often, because we don't like to talk about why us. And so I think we just have to get over that and kind of say, like, okay, I'm just going to talk about me as an object and brag about me as an object for a little bit here. Yeah, I'd say that's another kind of gotcha for especially Midwesterners. The other thing maybe to be aware of in this process is that you're being compared to a lot of other companies, especially on the coasts. You're being compared to people who blatantly lie. And it's actually a pretty common practice amongst entrepreneurs to blatantly lie about their metrics or to so heavily position them that any non-startup person would say, for sure, that's a lie. And that's probably how they justify it. But I actually had some conversations. And so knowing that you're being compared with people who lie, I think for me at least freed me up to brag, because I'm not going to lie, because again, our soul is the only thing we have left. But I'm sure I'm going to be bragging really heavily because I'm being compared with liars And I think that that's really important to know that. Sometimes I've noticed some Midwesterners like to come in and be like, try to undersell. Rye Walker would always do this. He'd like undersell the company, like, we probably don't have anything. And it was like, you're literally just taking out guns, shooting in foot. Like, that is not helping you in any way, shape, or form because you're being compared with people who oversell themselves. So, yeah. Other thoughts, questions? Cool. All right. Yeah, thanks a lot for doing this, guys. Thanks for coming and spend your lunch hour with me. Yeah. All right, cool.